So, class, we will start our third module. It is Financing the Enterprises. This module has three chapters associated with it. First is Accounting and Financial Statements. Chapter 15 is going to be Money in the Financial System, including the markets. A little tap on the markets, actually. And then Chapter 16 is going to be how you manage those markets and the interaction with the securities. For Chapter 14, our learning objectives will be to define accounting and describe the different uses of accounting information, demonstrating the accounting process, examine the various components of income, of an income statement to evaluate the firm's bottom line, interpret a company's balance sheet, and determines its current financial position. Analyze the statement of cash flows to evaluate and increase and decrease in the company's cash balance. All of this information is quite important for every business student. Whether you decide to become an accountant or not, you truly need to have a understanding of accounting. It is considered to be the language of business, and you will see in part through these three chapters that we go over why I would say that, and many believe that as well. Accounting is the way we measure and record information, financial information, but we also interpret it. CPAs are licensed by the state, and they basically are required in order to have an audit. But they also provide services that range from preparation of financial statements to filing tax returns. So a CPA has a variety of responsibilities. Accountants are not always CPAs. The one thing you need to note that CPAs must be are the only individuals who can certify anything. But accounting information can be prepared by bookkeepers, CFOs, and everybody else, but it cannot be certified other than by a CPA. Um, Accounting is extremely important profession, and it provides a very useful service. As a result, the level of trust needed, the level of trust given to CPAs and accountants alike is critical. In the past few years, we've had some scandals around the auditors and accountants that required some law changes. But more than that, the accounting profession is designed to help people make useful decisions using financial information. And once that information is compromised in any way, the usefulness of it is therefore gone. Thus, it is very important for accountants to be honest, to be true, and to be very, very transparent in their preparation and presentation of financial information. Now, accountants can be public or private. Private accountants, the job descriptions vary considerably, but private accountants are generally uh, employed by the government or corporations, small companies, small proprietors, etc. And they prepare those information for those organizations exclusively. That's their job. But certified accountants really are more, they really work they are certified from an external perspective, but they also have some more expertise in management. So they're more than just accountants. They know of the financial debits and credits and all of that, but they do have specific skills that certify them in managing. Now, internal users of information. As I mentioned before, accountants provide information for decision making. They have two interested parties. One is an internal user, and the other is an external user. The internal users generally are managers, generally are managers of the organization, division heads, and maybe even the CFO. And they provide information that they will allow the organization and its I guess their departments to manage, plan, and direct different activities. The cash flow is just more or less the going in and going out of money, but they need this information in order to plan, in order to monitor how they're spending, to assess whether or not they can afford to make various changes or make various opportunities or expand the organization. An internal part of the managing of cash flows is a budget. It is used for forecasting purposes. It is not intended to be 100% accurate, but it is a guide to help organizations use information to plan how they're going to spend or what's going to happen in the next few months or years, and how they best meet those obligations. Now, as I mentioned, there are internal users and external users. External users would be people outside the organization. And that being said, who could possibly be an outside organization or individual interested in accounting information for a various or a specific company? And The list can be many. But for example, depending on what is being done, the government may very well be interested in the organization's financial information. For filing taxes, for reporting information to stockholders. So the stockholders could be very much interested in the financial information of an organization. Banks who provide lending and cash and credit will be interested in that information. So there are so many people external to the organization who really want to know that the information that they're being provided is accurate. And they can provide that information through an annual report, which includes more than just financial information. It actually is an encompass of the activities of the organization throughout a year, and it is absolutely critical for that annual report to assist potential investors and owners how this organization is doing, what it has done, and a summary of their activities for the year. Audited financial statements are prepared by an examination from a CPA. And what the auditors prepare is a report saying, I have reviewed this organization, I have tested this organization, and their financial information is free of material error. You can rely on their information. That's basically what a CPA in an auditing function would do. Next is the accounting equation. Accounting has a very basic fundamental principle, and it's in front of you. It's the accounting equations. It means that all assets that organization owns must equal the combination of their liabilities and the equity. The assets is going to be what the organization owns and can control. That includes land, equipment, buildings, tangible and intangible things. A liability is a debt. It is something that you owe to somebody else. The individual could be a shareholder, it could be a vendor, it could be a bank, it could be the government, but it is something that is owed to someone else. You have an obligation. Equity is the actual value of the organization, equivalent of the assets minus the liabilities. So what we want to make certain is we want to make sure that every single bit of information that we receive from anyone regarding their accounting, that it follows this basic rule. This rule cannot be changed. This rule is permanent, and it guides almost every single thing that an accountant or CPA does. Now, why do we have accounting, and how do you know that this is acceptable and what's not acceptable, and how do you know how to prepare certain information? Well, the accounting standards give us that information. It is the standards that we use as CPAs and accountants to record various transactions, record and report various transactions. Now, accounting principles are going to be whether it be internal or I would say private organizations, which will be governed by the FASB, which is the Financial Accounting Standards Board. And it is also going to be the Governmental Standards Board, which is going to be entities that are governmental, whether it be state, federal, or local. They will have different set of accounting standards. These standards guide how governmental accounting reports are generated, are prepared, are recorded. And GAAP and FASB is going to be how private organizations report their various transactions. So generally accepted accounting principles allow both public and private entities to know what is a recorded transaction and how it should be shown in the financial statements. Also, we have this Financial Standards Advisory Board, and these federal government agencies allow individuals to come together to determine what kind of standards needs to be dealt with within the financial industry as well as within the government entities. Now, the International Financial Reporting Standards does allow us to be able to translate our U.S., which is the government, which is the GAAP, which is the United States GAAP, to an international type of financial statements. As you know, the United States government has a separate set of principles on how accounting standards are applied. However, those standards often conflict with other countries and their standards. And this is where the International Financial Reporting Standards come in. They provide that link. What are the differences between U.S. GAAP and international GAAP? One principle that I believe is fundamental to accounting after the accounting equation is double entry bookkeeping. What double entry means is with every transaction, there has to be a balancing credit transaction. So the assets that you, or the debits that you create in your transactions for bills or whatever, have to equal the credits. There can never be more debits than credits. And this really is more, I would say, for the day-to-day transactions which bookkeepers generally post. And it's recording transactions and maintaining a balance of the accounting equation. So we want to make certain that the accounting equation remains balanced. They've got to be assets is equal to liabilities and equity at all times, never ever a deviation. But you also have to make certain that each transaction is classified. You have to make certain that you're recording assets if they are in fact assets, liabilities or equity if they are in fact liabilities or equity. So what we want to do is make sure that our accounting system is consistent with the fundamental basics of accounting. Generally, the accounting system has 4 steps. You look at a source document, you examine that source document, you record transactions in your journal, you post those transactions, and with that, you prepare financial statements. Our journal generally has the information for transactions related to time. Daily, it could be, or a month. The ledger could be separate sections of those transactions, whether or not it's going to be a ledger that shows accounts receivable transactions, or a ledger that shows all the cash transactions, or a ledger that shows all of the accounts payable transactions. Each ledger has a specific file or a specific account that it provides details of the transactions. But once all the transactions are recorded, income statement is prepared, and this is one of the 4 basic financial statements. The income statement is going to show the profitability of an organization, whether it be for a month, a quarter, or a year. That financial statement provides a summary of all the revenue that was received for or earned for the period, and the cost of goods sold, the amount of money that organization has spent to attain that revenue. So what the income statement also provides is whether or not the organization has made money. To show that, it shows details of their gross income, which is going to be the revenues minus the cost of goods sold. But it's also going to show in detail a summary of all the expenses that organization has incurred over the period. Therefore, the difference between that gross profit and their expenses is going to be their they're going to be their net income. But the common expense is going to be sales, administrative, salaries, payroll taxes, research and development expenses, interest expenses, to say the least. There also is going to be some kind of expenses that are not necessarily relating to operating of the organization, but more or less the aging of your assets as you use to produce more income. And that's where depreciation come in. Depreciation allows organizations to take the cost of a long-lived asset and spread over the life that it's going to be used. And it is the most basic way of allocating and matching the expenses that you incur with the revenue that particular asset has generated. So that's going to be the matching principle that I'm discussing, and the depreciation is one example of that. Net income is going to be the profit after all expenses, taxes have been deducted from revenue. It is the income that generally organizations, whether it be a sole proprietorship, whether it be a partnership or a corporation, that is the amount to which the government will assess taxes. The balance sheet is going to be a snapshot. This balance sheet is only good for one day. That means if you take a picture of yourself, that's going to be you on that day. It's not you last week. It's not you tomorrow. It is you right now at that time. A balance sheet is not the most reliable simply because it is a snapshot. What we generally take with the balance sheet is we use it for purposes of historical measurement, not necessarily for how the organization is going to do in the future. It is only for a given moment. And generally, a financial statement is going to be at the end of the year, December 31st, 2000, etc. But it does give you some useful information, and it is a part of the basic financial statements. It shows the assets. It also shows the liabilities and the equity. Remember, the balance sheet is going to encapsulate the accounting equation because it's going to show the assets, and the assets is going to have to be equal to the net of the liabilities and the equity. So a balance sheet has its purpose and it has its coordinated process. It has to be presented in a certain way. And as you know, we have our assets, we have our liabilities, we have our equity. But when the assets are presented on a balance sheet, it has to be in order of liquidity. How can you convert this to cash, and how fast can you convert it will determine the place and the position that particular asset has on the balance sheet. So cash, green money in bank accounts are going to be the first to be shown on the balance sheet. What's going to be shown next possibly is going to be accounts receivable, simply because accounts receivable can be converted to cash within 20 to 30 days. Long-term assets and cars and equipment, those take longer to convert to cash because you have to sell those assets and you may not get the full value. It may take weeks, it may take months, it may take years, depending on how long that asset can be converted to cash. Therefore, long-term assets are going to be shown at the bottom of the assets in your on your balance sheet. Liabilities again are like like cash. The faster you have to pay it, the most liabilities have to be shown in order of maturity. So if you have a liability that's due in 2 years, that's not going to be considered a current liability. It's going to be considered a long-term liability. Current liabilities are obligations that are paid or to be repaid within a year. Accounts payable is one example of that. Generally, when you have accounts payable, you're going to pay those within 30 days. Accrued expenses are another current liabilities because they represent things that obligations that you've incurred, but yet to pay them. And these are more or less like salaries accrued or accrued expenses that you have not paid, which will probably be paid within 30 to 45 days. Again, these are just examples of current liabilities and their position on the financial statements. Sometimes organizations want to make some decisions about what they think they should do in the future. And pro forma financial statements gives you that opportunity to just see what the financial statements would look like considering some assumptions. This pro forma financial statements are not the actual activity for the period, but they are assumptions of what the organization's plans they might do and what the financial statements would look like if they made these types of changes. The statement of cash flows is a very important statement simply because it explains why the income statement says you have a profit but yet you're not able to pay your bills quickly. It shows what happened with your cash from the beginning of the period to the end of the period. It shows how you've used your money. It shows your inflows of money. It shows your outflows of money. And it gives the organization a good idea if they're using their resources efficiently or if they're going to run out of money. This statement of cash flow is presented in three different categories: operating activities, investing, and financing activities. And each transaction the organization has a cash effect, meaning cash coming in or cash going out, will be categorized in either of these three categories. Now, the ratio analysis is not a financial statement. However, when you're looking at financial statements, it's not always easy to compare one organization with another, particularly when the organization may very well be housed different or in a different location. So what ratio analysis do, it does help you to analyze the organization's health, financial health, but it is a method. It is a method that you can also use to compare one organization with another. And ratios give you some idea of what's going on, how healthy the organization is, whether or not the organization could very well be in trouble, and its relationship with other organizations of similar size and industry. There are the profitability ratios, and these are going to show how that organization is able to generate assets that will turn into equity and sales. They want these profitability measures like the net on the profit margin to show how well they're using that, how well are they earning profit. And they use those ratios to compare that with other organizations, because that can tell you if you're doing as well as your competitors, you are in good health. If you are doing poorly with other organizations within your industry, then you need to assess what's going on and make some changes. So profitability ratios are very important. Your return on assets is another profitability ratio, and it's going to be how do you return, how are you using your assets to generate future income, because looking at the ratio, it is comparing the total assets to the income. So it's saying based on your assets, how much of your assets are being used to generate more income. Very important. And the same is true with your equity. How much equity, how much income are you providing to your stockholders? So this particular one, a ratio is going to be analyzing the relationship between the income and the equity that the organization's owners would receive. Now, asset utilization ratios is going to be how well do you use your assets to generate it. I mean, it's very important that you understand that these ratios, like receivables turnover and inventory turnover, really tell you how well or how efficient these assets are being used. And the main thing about assets is we're using assets to generate income. So it's important to see how these assets are helping you quickly get your money back. Accounts receivable turnover is, well, if you have an organization and you sell services, and instead of getting cash, you get a IOU from that organization, and you say they're going to give you your money within 30 days. That's a receivable. Now, how fast you get your receivable turned into cash is very important, because what we want to see in this example, this particular ratio is saying 30.27 is the ratio. Well, that means that you're getting 30 times, you're getting a little more than 30 times per year. You're not getting the most out of your sales. Now, these ratios are very important, but most often ratios on their own are not a total indicator of something good or bad. They really need to be compared with others. And what we do with ratios is we make certain that the ratios are computed accurately and they give us an overall presentation from an organizational perspective, but we also want to consider the relationship that ratio has with an industry, with another or a competitor, because it gives you more of a value. Inventory turnover. Now, inventory is going to be huge because inventory is the very thing for organizations like wholesalers, how they receive revenue. So the quickly that they can get that inventory in and out means they're getting revenue quickly. And that's very, very important. So those ratios, in light of the organization and also in the industry, does gives you an idea of how well they're using assets to get their money or revenues. Now, utilization revenues, how fast are you turning your assets over? How much money are you spending in your assets that's going to turn over to another dollar in sale? Now, we care about this information because if an organization is not using their assets efficiently, then the revenues will be lower than they should. The sales would be lower, and the expenses will be too high, which would affect, obviously, their profitability. So organizations use these liquidity ratios to assess how well they're doing or how poorly they're doing, and it gives them some guidelines as to what to tackle when to correct negative ratios. Liquidity is all about how much money we have. How much cash do you have right now to pay your short-term debt? We want to make sure that we have more than enough money to pay our short-term needs. Therefore, high liquidity ratios are very good, generally speaking. Liquidity ratios also are used with your asset ratios, your asset utilization ratios, because they do help you imply that if you are getting a high turnover in your inventory, your liquidity ratios are going to also be high as well. These ratios work in conjunction with one another, and they do have a direct relationship, which means if your asset turnover is low, your liquidity is going to also be low, because your asset turnover means you're not turning your inventory over, you're not turning over your assets quickly enough to get cash. It's going to affect how you pay your bills. Your current ratio is going to be basically your working capital. What is your working capital? And generally, working capital is going to be assets, current assets minus current liabilities. And your working capital is saying how much of your money is in liabilities and how much of your expenses or your assets is on hand. How are you using your assets, and what's the relationship between your current assets and your current liabilities? We want to see how much of your current assets are being taken or used by your current liabilities. Now, the asset test, the asset ratio is good. The current ratio is very good, but the quick ratio is very, very good, because it's really talking about, we really, really are concerned about your assets, but we want to make certain that we take out of that number the things that we can get extremely fast. It is the asset test of how you're using your monies to pay, or how much of your assets are being utilized by your current liabilities. Now, organizations that have debt, they need to make certain that their debt is, I would say, very much consistent with their revenue generation. And how you use debt is important because some organizations have to ensure that they are not overly utilizing debt, that the debt is not being used up in paying expenses like interest, and that the monies that they earn are not being taken away basically and given to the lender. How well are you using your debt? And also in light of your equity and in light of your assets. So the test that we're going to use is we're going to say, how much debt do we have to assets? What's the relationship between your debt and your assets? And generally, that if you have a debt of 40%, you have to conclude that 60% of your growth of your organization is being financed by revenues and equity, and 40% of your organization is being financed by debt. Organizational debt levels is really relative to the organization itself and the guidelines that that organization has established. However, it does show some risk for organizations who are looking for investors if you have a high level of debt and you have a lower relationship to your income or your equity. Now, for organizations that have debt, times interest earned ratio is very important because it's going to be a measurement of how much of your interest expense is being covered by, or is being, I would say, used to offset your income. So this number here is going to be important because if you have a high level of debt, then the interest that you are earning, or you're actually having to pay, is actually reducing the owner's profit. Now, organizations that are public and they have stock available to use to individuals outside of their ownership, they have outside owners. Per share data is important, and it's going to be your earnings per share. How much are you earning per share of stock that you have outstanding? The diluted earnings per share, it only is necessary when you're talking about organizations that have convertible bonds that can be potentially converted to common shares of stock. So if an organization does not have bonds that are convertible to stock, then you will not see a diluted earnings per share. However, all public companies will have an earnings per share number. And what happens with earnings per share is how much is that stockholder earning, based on their number of shares and based on the income that organization. Because you look at here, we're looking at the net income and we're looking at the number of shares outstanding. So we're comparing the relationship between the income that organization is receiving and the number of shares. So that means that each one of the shareholders is earning $1.62 for every share that they own. Now, for organizations that provide dividends, if you're trying to invest in an organization and you utilize dividends as a part of your earnings strategy for investing in those organizations, the dividends earnings per share is a very important number. It's very important to know that with all the dividends that's been paid and compared with the outstanding shares of stock, they are paying 52 cents on average, 52 cents of dividends for that ownership. So what I want to make clear with this chapter is you're not going to become a CPA reading through chapter 14. You're not going to become an expert in accounting. But what I would like to see, however, is for you to understand the importance of accounting and the importance of integrity in accounting. And also if you understand how important accounting is to the profession and how it is important to the economics of this country. We are in dire need of integrity in accounting because people like yourself use accounting information to make very important decisions. And these decisions have to be based on reliable information. So we need to have integrity in accounting. So as you finish this chapter, understand CPA, the goal of this chapter is not to make you CPAs, but it is important that you understand why accounts are important. What function do they perform and why is it needed? And why are ratios, particularly debt ratios, are important in assessing the risk of a firm? Why do we care about the financial statements? What do they mean? And why do we use ratios? Don't be concerned, however, on the ratios or how to calculate them. Just understand what they do and why we need them. Thank you very much for your time, and I'll see you in the next one.